Hello, thank you so much for tuning in and watching us on Morning Markets. We've got a great show for you, including what's been going on with Bitcoin after a ruling in favor of crypto asset manager Grayscale. This could pave the way for the first spot Bitcoin ETF in the United States. We'll speak about what happens next and the path to getting that done with Grayscale's chief legal officer. That's coming up in just 15 minutes. And on the flip side, you know him from the OC, but the actor turned author is taking a very harsh look at cryptocurrencies. You won't want to miss that interview. Ben McKenzie will be our guest at 10:30 a.m. Eastern Time. And with tech leading the charge in the rally in the last couple of days, David Sequeira says it's time to sell those winners and look at some of the more unloved parts of the market. You won't want to miss that interview coming up at 11 a.m. Eastern Time. But ahead of all that, we're still chewing on these bank earnings. National Bank is the latest to come out with a set of quarterly results that missed profit expectations by a wide mile. To get some perspective, we got Diana Avigdor, head of trading at Barometer Capital Management, and Andrew Bell has been going through the details of this report. He joins me now on the desk. Andrew, what jumped out to you?
It looks as though trading revenue was the problem. You touched on that earlier. So the profit was 5 or 6 cents below expectations. Adjusted profit down 6% year over year for National Bank. And I think you noted this, Amber. It's been an investor darling. It's led the banks higher this year. So giving up about 2 to 3% in early trading. And I know people, our viewers have heard this before, but trading revenue, often banks or investors don't get that fussed about it. Here is what Cormark Securities has to say. Given it's a lower quality source of revenue because it's more volatile, we're less fussed by misses here.
Well, because the core banking business held up and net interest margins, I believe when you exclude the trading business, actually ticked up from the previous quarter. And you didn't see that at the other major banks.
Yeah, I mean, the bank is still growing. And there's what Barclays has to say. Underlying growth was decent. And so no fundamental problem, it appears. Now, there was provisions for loans were up marginally for underperforming loans. They were $111 million, but Cormark was looking for $115 million. So certainly they rose, but I don't think that's alarming, analysts, this morning.
And we've seen that across the banks. They're all taking them up because they were very low during the post-pandemic period.
That's right. And expenses were up about 7% year over year, but that's less than some of the other banks. Yeah. So it looks as though this could be a knee-jerk reaction to that top-line earnings miss.
I mentioned the outperformance of the stock, in part because it is domestic focused. Are there any other drivers to why the stock has been doing particularly well?
The fact that they're not in the United States is one big thing. A big part of the story, though, is speculation. Will they buy Laurentian Bank?
Oh, okay.
Now, at the time when Laurentian indicated was looking for alternatives last month, Veritas, Nigel D'Souza, said, and TD said, we think National Bank could be a logical buyer here because they both have Quebec focus, or they have extensive operations in Quebec. However, the other side of that coin is Lamar Persaud, the analyst at Cormark, thinks that, in fact, National Bank is trying to diversify
away.
It's watered down its Quebec exposure. And so they may be less interested. And at that time, the Cormark analyst assigned only a 25% possibility to Laurentian actually finding a buyer, because Royal Bank's busy with its acquisition or would-be acquisition of HSBC's Canadian operations. Bank of Montreal is still digesting Bank of the West. And I think one or two of the banks have publicly said, or at least sources have said, that they're not interested in Laurentian. So it seems very uncertain.
Yeah, what's going to happen with that?
It's going to find a buyer. Laurentian is a minnow, though. I hadn't realized it was so small. It's HSBC's Canadian ops are 2.5 times bigger than Laurentian's asset base.
All right. Thanks so much, Andrew Bell, for putting those issues on our radar. I want to bring in Diana Avigdor here on what to do with this stock that has outperformed and kind of a turn of the narrative where all of a sudden Canada is in vogue. Do you want to buy the dips on a company like National Bank?
Hi, Amber. Yes, you do. I mean, National Bank has been a darling because it is an entrepreneurial bank. It has cleaner exposure, more domestic than all the other banks. NIMs have been stable, and I heard you speak to Andrew Bell before. If you took away the trading exposure or the trading weakness, their NIMs were actually up 3 beeps, which is very much unlike the other banks that have other exposures. NIMs have been more compressed in the U.S. than they have been in Canada, partly because Canadian financial market is not as competitive as the U.S. So for us, we're not fussed over a 2% weakness after the earnings. We see, and I always talk about this, markets price things in ahead of the news. National Bank has outperformed its peers in price action, so it makes sense that it will be down a little bit. 2% is not all that much given the big picture. Yesterday, some of the banks that reported weaker quarters actually traded up. So it kind of shows you where they're positioned in terms of pre-earnings setup.
Yeah, although, when people do talk about buying the dips in the banks, they often point to valuation. And I wonder if National is just as attractive on valuation given the run-up. I mean, it's got kind of the same PE, which is a simple way of looking at it as nearly Royal Bank, which, historically has not been the case.
Yeah. Canadian banks are trading very, very low valuations, low price to book. You're getting paid to wait this out. Banks will generally work in the same direction, plus minus, to where the economy is going. And with the fear that we're slowing down, and the economy has slowed down somewhat given the rate hikes, these banks have priced that in. And you're starting to see, just like you're seeing on some other things in the market, you're starting to see where the negative news no longer impacts the pricing. So National is a little bit different because it kind of did a lot better than the rest of the banks. But they're so much more domestic, and their growth is still ahead from an international perspective, and there's no better time to start it.
So does that mean the recent, I guess, divergence in performance, the domestic banks outperforming and the more international ones underperforming, that's not a trade you would look to, I guess, continue? You'd want to lean into the underperformance of some of the internationals?
Well, so we own TD as well, and we like it. We actually own more TD than National in big pictures in dollars, but we own both. And the reason we like TD is, they actually lost 16 beeps in NIMs because of their U.S. exposure. Yeah. But it traded up after the report. And, it has a pretty high a strong capital position. It has a couple of billion of excess capital. TD is also buying back stock at a higher than expected level. So the quick answer to your question is yes, we would buy the cheaper and the international growth. There is a sense that NIMs have compressed enough, and they're probably going to stop compressing in the U.S. as the rate hike regimen stops being so aggressive. I mean, the market's starting to price in that Fed Chair Powell is pretty much done. Yeah. And so with stability and perhaps looking forward rate cuts, these NIMs should stabilize, if not expand.
I'm glad you brought that up because I wanted to ask about the broader market. Since Powell spoke on Friday, the S&P has traded up. We're now on a 4-session hot streak if today's gains hold. And it seems like we're back to that old refrain that bad news is good news when it comes to the economic data, the job picture. It seems like it's not tightening anymore and maybe is loosening. Are you in that camp that, November rate hike odds are definitely looking like less of a probability?
So this is a great question because we are now at the toughest time for policymakers because how much more calibrating they need to do given that their rate hike impacts are going to be delayed in what we're seeing. Weaker than expected data is now pricing in a lower yield, and so that's supportive of the market, but we don't want it to be too much. The good thing that's been happening is this: the U.S. labor market has been in a bit of a dissonance, and that's coming into balance. So, people were, look at a year ago, people were quitting, very confident that they would get another job very quickly, and then jobs offered were not in line with the people looking. It was a lot tighter. It's now coming into balance, which is putting less pressure on the wage component of the unemployment market without losing actual jobs. So the JOLTS number yesterday actually showed a little bit of weakness, but the labor market is coming more in balance, which is great for the wage component, which would be inflationary if it continues to rise too much.
All right, Dan.